Welcome back to Fast Market here on the TD Ameritrade Network. Let's bring in our next guest for our cash tag segment, and that's going to be Landon Swan, the co-founder at LikeFolio. Welcome back to the show, Landon.
Thank you. Good to be here.
All right, so we're talking Shopify. As I mentioned before, stock's up about 33% so far this year. It's rebounded, got a nice upgrade yesterday. Are you guys seeing data out of LikeFolio that is commensurate with this move that we've seen in the stock?
Yeah, we are. Actually, when you look at Shopify, it's got some trends that are helping it, some trends that are hurting it. I mean, if you look at shoppable content, for example, it's up about 56% year over year. Mobile shopping plus 13% year over year. E-commerce is where we're a little bit concerned. And I'm starting with the bad right now because there's good coming. But e-commerce passed $1 trillion in 2022 last year. First time it's done that. It's growing at about just under 8% year over year, which is actually the slowest growth rate since 2009. So e-commerce is slowing down. The actual dollars data shows that. Our data shows that as well. So that's a little bit of a concern. However, this is the winner in the group. Shopify is doing a fantastic job. If you look at download and usage data, it's up about 6% year over year, which is that green line right there. That's the 90-day moving average of purchase intent. And you can see it's basically at all-time highs, while the stock is off quite a bit. I mean, you talked about how it's up since the beginning of the year, and it is. But when you look at where it was, a year ago, a year and a half ago, it's really down compared to where it was. So purchase intent being so high and the stock price being fairly low relative to a couple of years ago is pretty good divergence opportunity. So we're seeing a lot of people really happy with this, and they're increasing the number of usage in visitors and usage downloads at really high rates. So we're very happy about that. When you compare them to some of their I'll use the word competitors, but it's tough. It's tough to compare to their competitors. You do a scatter plot on that, they're exactly where you want to be, top right. This is a company that's done very well. Etsy, I think, would be one of the, maybe closer ones. Amazon. You can make an argument for each one of these having a competitor component to them, but Shopify is fairly unique, and they are doing really well. They've got extremely high customer happiness, up there near 85%. And they're the only ones growing of this group where, as I said, e-commerce has been slowing down. The growth rate has been slowing down quite a bit. So we love where they're at now. And, they were upgraded today by JMP Securities, who is not a client of ours, but if they were, they would have been on with us when we upgraded them back in January. So, we've been bullish on this since 38. We put out an alert to our clients. Looks really strong, everything moving forward. Again, got some macro going against them with the slowdown in e-commerce, but they're the leader. They're the one that is really enabling people to get on and monetize their content, monetize their website very, very quickly and easily. It's just the best app out there. So I think they're doing a fantastic job, and I'm looking forward to how they do over the next few months.
Landon, I'm going to keep my question pretty simple because it's kind of a theme here, and that is, Shopify has a lot of entrepreneurs, a lot of small companies on there, which frankly is probably a little more risky, right, when you have a lot of small companies, but they keep landing bigger and bigger companies like Heinz and Nestle and Allbirds and Netflix, and now they just brought in this streetwear company, Supreme, and Mars, another company. Is it crucial for the future of this company to keep getting the big, more stable, more dependable companies on their platform rather than the small little entrepreneurs in terms of overall risk?
Well, I don't think that I'm going to be biased here. I don't think that the small entrepreneurs are at risk because it's a long tail play. I mean, if you get 1,000 small entrepreneurs, maybe half of them are going to fail. But you have so many that it's going to be a fairly predictable number over time. And the ones that succeed are going to grow and become medium-sized businesses. Maybe one day they'll be one of the large ones. But I do think that the long tail definitely works for them. But of course, if you're going after, the maximum number of revenue coming in through your program, you're going to want to have the big clients. And the fact that they're able to land those, I think, really says a lot about their ability as a company to increase their revenue. So I don't think it's risky to rely on the small entrepreneurs because there's just so many. I mean, if they had all their eggs in one or two small baskets, then yeah, that'd be concerning. But it's a long tail play where all of that, there's thousands and thousands that are going to add up to the equivalent of a few large companies. But of course, getting those big ones in the door is big for the company. And again, demonstrating that they can do that is very bullish.
Yeah, and they do rely on the consumer, right? We've got retail sales coming out tomorrow, so we've seen spending pull back on goods, not maybe on services so much. So when you look at this and you look at the trend that you guys are seeing on that 90-day average, on that one chart you had, I mean, the divergence between the stock price and some of your data continues to expand at this point, even though we've seen that rally this month. Do you see that, propelling them moving forward because they are that unique product in the e-commerce space?
Sure, and I'm glad that we got this chart up right now because you can kind of see what happened here, right? They were on a nice run and things were starting to grow, and then COVID hit and they expanded tremendously. Everybody wanted to start an online business, and this was the easiest way to do it. So their numbers started coming in really attractive. I think the stock reacted a little late to that, and then it kind of got a little, I guess, ahead of itself, and it started anticipating that steep uptrend could continue on forever. And when it didn't, investors came back down to earth and said, you know what, maybe this isn't just a moonshot right away. This is going to take some slow growth. But what we're seeing now is that the uptrend has continued. The pre-COVID uptrend has continued, and it's just at a higher level now, and it's a little bit more expanded, right? It's been multiplied. So I would say that if you look back on this, compare it to the stock price compared to where it was pre-COVID, and you're thinking, well, this is a deal, in my opinion. I mean, this stock price is very undervalued. In fact, when we put out a report on it in January, it was part of our undervalued, oversold bucket of stocks. And you might not think a company like this that's a little bit more, tech play, a little bit, I guess, riskier compared to some of the other companies that you might call oversold would fit in that category, but it absolutely does. I do think this is oversold. Even today, when it's at 46, we went bullish at about 38, but and I think the upgrade today had a price target of 65. But based on where the trajectory is, if the economy turns positive at all, I think this one could really run. It could double over the next couple of years. If the economy stays a little bit more stagnant, then I think a 50%, 75% move from here over the next 12 to 18 months is very reasonable.
Yeah, so still positive. And remember, I mean, this stock was trading over $176 a share in November of 2021. So even though the stock has moved up this year, I think you make a good point that the data is still trending higher and it's still relatively low to historical values. All right, Landon, great stuff, great data as always. Appreciate it.
Thanks, guys.
That's